Good morning, everyone. We are at Wednesday. It is May 14th. We are enjoying a nice market this week. Monday was stupendous. Tuesday followed up with a nice rally, especially around technology. And we'll see if the market continues the nice rally. Looking at the futures, looks like the NASDAQ is going to open up a little higher. We're about 30 minutes from the open, and we've got the S&P futures up a tiny bit. So we'll see. This could really change and go the other way, and investors could be taking some profits because it has been a really profitable week. One thing that came up really over the weekend was gold, and it's been interesting how gold has really flourished over the 1 year and the 5 year. We've had a lot of inflation that started in 2022, and gold really went up and is enjoying very good prices. So investors in gold have done really well. But more recently, it has given up some of its gains. I think as we get some of these problems sorted out, you had a big tariff war. When that begins to get resolved, I think some of the risk comes off the table, and you're seeing gold prices kind of settle down. As the economy gets better, as the government reduces spending, organizes better, gold prices will settle down. If there's more fear, gold prices will go up. That's just what they do. That's why it's a hedge on the stock market. Gold does well when things get scary. So interesting to see gold move the way it's moved. Looking at Asia, um, looks like Shanghai is opening up nicely to the positive, or I should say, they probably already closed by now. They're way ahead of us in the United States. And Shanghai, it looks like it traded up. The Hong Kong exchange traded up nicely, 2.3%. So stocks in China are doing well. Chinese stocks have done really well this year, and they really have been doing terrific for about 6 to 8 months. And they had probably about a 2 year run where they were terrible, but they've done really well 6 to 8 months. The resolution of tariffs just helps the whole China trade. So the China trade really worked in the fall of 24. It's worked for the most part since then. But now that you have tariffs kind of figured out, okay, it's game on. I think China stocks are going to continue to go up. So that looks good. Take a peek at crypto. Bitcoin is at $104,000 per coin. That looks good. Really good. So that looks good. And we look at the futures. Futures are still where they were at. No big news to report. I don't think there's any big economic news that's going to be reported. When we look at the different sectors, right? Every stock belongs to a sector, and the sector is made up of different industries. Kind of makes sense. Tells you, hey, financial companies belong together, technology companies belong together. And when we look at those sectors and look at the performance, materials is still the number one sector, but it's a small sector. Financials, very big sector. It's doing really well. Financials probably creating the most wealth, most market cap of all sectors this year. Utilities doing well. Staples are doing well, but staples have been fading because as growth stocks begin to work and they really show really great numbers, like, wow, you could, you know, buy a stock and it goes up 25%. Why would you be sitting on a consumer staple that might go up 10% this year? So staples have been kind of losing some of their air, some of their energy, and everything else is kind of below the line. Technology went from deep red to green now, which is cool. Kind of some notable names. NVIDIA did really well yesterday, and it's up in the pre-market. I think the semiconductor space is really catching fire, so it's neat to see NVIDIA do well. But if you look at the NVIDIA stock chart for the 1 year, it's not doing great. It's just kind of a flat stock. It did phenomenal 2 years ago. Hands down, the best, most important stock of 2023, and even 2024, it flourished for a good part of it. But now it's not so much, and I think Broadcom is overpriced. So, but we'll see how they trade. Palantir had a great day yesterday. Uber had a good day. Um, Arista Networks had a good day. Meta's been on a really nice tear for 2 days, up about 10% over 2 days. Google's just kind of hanging on. Google's kind of been not been treated all that great by the market. I think there's a lot of naysayers selling off Google. Amazon's flourished after they announced, hey, the tariffs are going to be squared away. The Amazon stock's just been doing great. So good stuff. Airbnb and the travel stocks, travel services have been doing really well, which I'm not quite sure what's changed in that space. I don't know that the consumer, automatically is like feeling confident. I think that travel's still going to be lower than this year in 2025 is going to be lower than 2024. That's my expectation, just because I think people are being cautious. Although we're getting some of these big macro problems squared away, you still have a lot of layoffs. Microsoft announced that they were going to be laying off 3% of their workforce. That's another example of how job losses are coming into the picture. And I think that affects travel. If people are a little nervous about their employment, they're not going to book a big expensive, vacation trip. Maybe they're like, hey, let's hold off. Let's kind of save our money for a little while, and then we'll start vacationing once we feel like I'm going to be employed and I'm not going to, be at risk of losing my job. So I think that's we'll see how travel performs, but travel tells us a lot about the consumer. If the consumer's confident or lacking confidence. The space that got hard hit yesterday was healthcare, and United Healthcare was probably the one that lost the most market cap. It was down 17.79%. Man, what a shellacking. And it brought everybody down because it's the biggest player in health insurance. Now, I took a look at United Healthcare a little while ago, and it is up in the pre-market. It should recover some of that drop because it was a drop because the CEO resigned. And, that is bad news, but it's not structural bad news about the business. The business is really good. It grows its revenues, it's profitable, generates free cash. So I actually think United Healthcare now is an attractive idea that's discounted. I'm an Elevance investor, so I'm good in this category of companies. But I could totally understand investors now being attracted to United Healthcare because the business didn't change. The CEO decided to ride off into the sunset and retire for personal reasons, and we don't know what that is. But healthcare got hit hard. United Healthcare, that was the direct story there. But there's also the government is looking to reduce cost of, or I should say, the reimbursement rates, the negotiated rates with pharmaceutical companies. So that affected pharma. If it's going to be negotiated, prices are going to be negotiated, maybe some of their profits will drop. So I think that's what hit the space as well. Staples, as mentioned earlier, these guys are losing some of their appeal because, hey, why do I want to be here when I can be here? NVIDIA is going up 5.6. Meta is going up 2.6, 10% over 2 days. Amazon's gone up almost 10% over a couple of days. Why do I want to sit in a staple where it's more stable than the growth stocks? But if you look at a 5-year performance chart, you lose out on a lot of appreciation you could have had with growth stocks. The one exception is Costco and Walmart have been appreciating quite well over the last couple of years. So it's kind of been weird that staple companies act like an appreciating stock, not quite like a growth stock like a Palantir, but it's doing better than a staple stock. So it's been interesting. Energy prices of oil really popped up once we got the news that, hey, tariffs are going to be dealt with. I think the expectation is the economy is going to do better globally, and there's going to be more consumption of energy, crude oil, natural gas, and so forth. So energy companies have been doing well. They've been having a good week, been having a nice couple of weeks, and they needed it because oil prices being really low really brings down the revenues for oil companies. No big surprise. Looks like Shadow Guys tuning in. Good morning. I know that you're in Europe, so it's good evening for you. So cost potential for international growth partly justified its valuation. Yeah, Costco is an incredible success story, and I know that they're doing really well in other countries. Um, I've noticed that they are in Mexico, and they're doing really well in Mexico. Seems like Mexico, looks over the border and says, "Man, we want Home Depots, we want Costcos, we want like that type of retail and businesses down here." So Costco is doing really well internationally. I agree with you, and they're in Puerto Rico, Canada, Mexico, Japan, United Kingdom, Korea, Australia, Taiwan, China, Spain, France, Iceland. Yeah, they're everywhere. So yeah, they're doing well, doing well. And I think their model has worked. I mean, it's not a super fun model, it's a super value model. They really deliver for their customer. So good job, Costco. Every time I go to Costco, just about every product in there, I think that's part of their appeal is it seems like the products you're going to get a good value. You may buy a portion that's fairly big, right? You know, um, like I can buy almonds at Costco and I get such a good deal. I get a giant kind of plastic jar for the same price that if I bought them at, let's say, Trader Joe's. I would only get like maybe a fourth of the volume that I'm getting in that product. And across the board, you can look at every product, so they deliver great value. And it's no frills, right? They don't even have shopping bags. They give everything to you in the boxes that the product was delivered. So really, really good institution. And we always shop at Costco whenever we're going to have a big party or get together or just to go get a good deal. So Costco's really gotten it done. If you look at the 5-year, 227, beautiful. This was Charlie Munger's baby. He loved Costco as a stock, and I could see why. Every time I value Costco, I can't get to their valuation, but the market thinks very highly of the company. And look at the stock price, 227. Good job, Costco. PE is a little high, and that's an example of what I see when I'm looking at Costco. That PE is really high, but their growth isn't, stupendous, 6%. It's like, man, we're almost at a 60 PE with a 6% growth rate. That's what I look at, and that's what I have trouble with. Sebastian, how are you, sir? Thanks so much for your support of the channel. And thank you, Shadow Guy. Appreciate you supporting the channel. And I don't know if I have, Sebastian, your email, and I'd like to invite you to member calls and give you access to the tools and everything. So if you want to look up my email address, it's on my homepage and get me your details. That'd be great. And I can get you all set up. And thanks again for your support. All right. So yeah, Costco, the free cash flow is good, but it's not booming. So that's just, my decision. I'm not a Costco shareholder, but I'm not going to talk anybody out of it because it's done really well. And it is one of the big positions that Charlie Munger had. He really believed in that model, and he was right. So congratulations, Costco stockholders. So we have some earnings that have come out, and when we look at, Sebastian wants to look at power. So we're going to jump right into a member request, and then we're going to come back to the earnings. We do have some earnings that have come out, but let's take a look at power. think it's power. PWR, Quanta Services. So Quanta Services offers infrastructure solutions for electric and gas utility, renewable energy, communications, pipeline, energy industries in the United States, Canada, Australia, and internationally. The company's electric power infrastructure solutions segment engages in the design, procurement, construction, upgrade, repair, and maintenance of electric power transmission. Okay. So I'm going to open their website just to make sure I have the business kind of, I like to say, I put my head around it. Like, okay, what is it? What are they doing? So capabilities. So it looks like they're doing the maintenance, right? So if you need infrastructure maintenance or maybe building the infrastructure, this is a company you're probably going to do business with. You're going to hire. Now, the grid is getting upgraded quite a bit. You have data centers that are coming online that require a lot of power. So I imagine these guys are fairly busy. Now, I would like to understand. So these guys are services company, infrastructure services company. They're also, I would view them as a construction company, right? They're, building something. They're awarded a long-term project. Might be 2 years, might be 4 years, and there's a work breakdown structure to that contract. Like, hey, you're going to do all this construction. You're going to build a grid between the city of Chicago and the city of Detroit and so forth. So that's what this business is all about. Let's take a look at their investor page real quick. See what we're dealing with here. And they announced their earnings on May 1st. Okay, so I'm going to have this ready and then we'll come back to it. So let's get back to our stock analysis, so we know the business is, based on infrastructure services. It is a good business for the time because power has become really important. Interesting that over the last year, it's up 26%. We see the volatility. I love volatility because if I'm interested in a business and I'm interested at this point and then the market discounts it, bingo, there it is. Nice discount on the stock. So that looks good. 5-year, geez, almost 1,000% return. Incredible. We'll take a look at their revenue growth and see if their revenue growth matches this appreciation. So that looks awesome, man. All right, so this is a close to $51 billion market cap company. Their revenue, $24.87 billion. So you're paying a tiny bit over 2 times revenue. And this is a construction company. Construction services companies, they don't carry big valuations, meaning like if you look at a technology company that has high growth, you may look at 15 times sales. It's an expensive stock because it has high growth, high profit, and will likely be a high free cash flow producing company. Where you have construction companies or services companies like these, there's apprehension there because at times, if a construction company gets awarded a big contract, maybe their revenue doubles, but it's not like they're going to earn a contract of that size every year. And it's not, their high growth will not be sustained over the long term, but a tech company could because their technology is going to be used by billions of people. So we'll keep that in mind as we look at their financials and see what's going on with their fundamentals. So the PE is a little high, 55. That's an expensive PE. They're going to have to show growth, and we'll see if we believe the growth is going to be sustained. Forward PE is close to 32. Tiny little dividend and price. Analysts cover this stock and they think it's fairly priced with a premium of 2.72. So now let's take a look at the growth. Now the growth is good. It's just not incredible, right? We had a stock that's gone up almost 1,000% in 5 years. And the numbers are not like making my head explode. Numbers that would make my head explode are like NVIDIA. When you look at NVIDIA's numbers, these do make my head explode. Like, whoa, 125% on a big number. Wow. And then this number here, they just finished their fiscal year that ended January 26th. These are staggering numbers. Yeah, I get the stock's going to do this when you have that type of growth. Okay. And when we look at these numbers, these are good numbers. They're just not NVIDIA incredible. They're not that incredible. So that's one reflection, I would say. The other thing too is you see how revenue, the cost to produce that revenue, not a lot of margin left. And we're going to look at the margin percentage. That's why construction, I haven't been a big investor in construction because you need to pay quality employees as you should to do the work. It's usually hard work. You have to have skills. Maybe it's hazardous in some way. So all those things add up. And every project requires a lot of labor. You might have a lot of materials and so forth, insurance to do the project. So the margins are going to be a little tight. It looks like Box for Fun became a member. Thanks so much. I really appreciate that. Thank you. Let me know. You can find my email. Get me your email address so I can get you all the perks, invited to member calls, make sure that you get every benefit that members get. I really appreciate your support. All right, so we're going to look at free cash flow. And here's the free cash flow. Now, again, these numbers are good. It's really gone up. And the trailing 12 months represents the last 12 months. Their last full year ended December 31st, 2024. Good number. I'm going to call it 1.5 billion in free cash. Now, let's look at some of these margins. As mentioned, see this gross margin is 14.83%. When we look at an NVIDIA, it's going to be like 85%. Or you look at a pharmaceutical company, it's going to be 85%. They just make so much more money. And that's just one more characteristic that I would focus on. We have the opportunity as investors. We get to invest in whatever company type is out there. And the ones we should focus on companies that we can really understand. Warren Buffett calls it the sphere of competence. Within a sphere, you really, like for me, professionally, I've worked in some healthcare. I've worked a lot in technology. I really understand communication services. And my life experience and business experiences led me to a lot of different industries. So I put companies in my sphere of knowledge, but also the knowledge of which companies are the best ones at producing profit and cash. And when we look at a company like this, you just need to be aware this is a low gross margin rate. You have high gross margin rate companies, Meta, and I can go down a long list. This one's not one of them. Their profit margin, 3.72 or 74, excuse me. Now that's like we can earn better than that on a money market account right now. So that's not very good. And then the free cash flow margin isn't very good either. Now, what's driving this stock price is many times the stock market really buys into a big story. And the biggest story that we've seen in the last 4 years is AI. AI being the next paradigm, the next generation of software, of using online software, using search and getting answers to questions, having artificial intelligence do activities, perform activities, and so forth. And in order for AI to happen, more data centers will have to be built. Those data centers and companies related to the data center are doing really well. And those data centers are going to need power. And that's why this company is growing. That whole story, I'm not arguing with the story. It's real. I would just point out that not all companies are the same. You can't treat them all the same. I like using this analogy. I'm in the US, so my favorite sport is American football. And on a football team, the quarterback is probably the most important position and the highest paid position. Let's take the Super Bowl champion Philadelphia Eagles, right? You have their quarterback, and on the same organization, same team, you have these really important people, and you have the equipment manager. And the equipment manager, they make sure that the team has the right equipment, their uniforms, all those things. Without uniforms, without the darn football, you can't play the game. So the equipment manager is important. They're both part of the same team. The equipment manager, the quarterback, they're part of the same team. They both go to work and work their butts off to do the best job they can. Now, the pay rate for a quarterback is probably 25 million, 50 million a year, where the equipment manager, same organization, 75,000 a year. Okay. And that's all normal. Everybody understands that. Now, if you asked me, hey, which job would you like? You want to be the quarterback or you want to be the equipment manager? And I would answer, with all due respect, I'd like to be the quarterback. I'd rather make $50 million a year versus 75. And that's what you're looking at when you look at stocks. Even though this company is in the AI build out and part of data centers and producing the services that will produce power to data centers, they're more looking like the equipment manager than the quarterback. So be aware of that. We can't price them like an AI stock, like a data center stock, like a utility stock that's driven by the data center. We have to be careful. All right. So those are some comments there. So when we look at this number of 1.5 billion, when I look at growth like that, I might say, hey, I'm going to multiply that number times 20. I'm still going to do it, but I would be careful because their profits are so low. I'm still going to do it just to keep the math easy, but 1.5 times 20 gives us 30. That's $30 billion of value. This is kind of high level, back of the napkin kind of calculation. 30 billion minus debt. Let's see how much debt they have. We're going to look at debt. And they have $520 million of cash, 4.75 billion of debt. So net debt's like 4.25. So 30 billion minus 4, so we're at $26 billion of value. Now I do all that because I do that quick calculation to see, do I want to invest more time and energy into this valuation? And if I'm at 26, but the market cap's at 50, and I'm seeing a stock chart like this, I'm like, this one's way overpriced. Very, very overpriced. Once the revenue slows down, this stock's really going to suffer, in my opinion. And it's not like they're creating gobs of cash, right? Let's go back to NVIDIA. NVIDIA creates gobs of cash, and gobs is not a financial term, but I think you know what I'm talking about. Look at this cash flow. In the last full year, they have a fiscal year that ends January 26th. They generated close to $61 billion of cash. They generated more cash than the market cap of the company we're looking at. That is super high cash flow generation. And you look at how it accelerated, right? Before the AI build out, they were down here at, call it an average of 6 billion per year or so. Now they're at 60. because of this gross margin number. Look at that gross margin, 75%. That makes sense because NVIDIA developed this GPU technology, a semiconductor, and they own the intellectual property. That means you own the rights, the patent. And then they send an order to TSM in Taiwan. That is the foundry. They produce the chips. They get delivered. NVIDIA charges its customers $30,000 to $60,000 per chip. So they are making lots of cash. When you look at their margins, profit margin 55%. The company we're looking at is like 3.6%. So we are just two different animals altogether. Yet the market is treating the equipment manager of the Philadelphia Eagles, kind of putting them in the same category as the quarterback, running back. The defensive line of the Philadelphia Eagles was awesome in the Super Bowl. And don't make that mistake. This is a good business. This is a quality business. They're doing really well. But for me, I would not invest in this company because I think it's overpriced. And once because we have had it, we have a letdown in building of electricity. This stock could really get punished, and the investors are the ones that get punished. The ones that own the stock, that see their stock go from 348 to 200, they're the ones that really feel it. Those are my comments on it. So the company, it's a good business, really good business. It's growing. But I don't want to invest in a lot of construction companies because of the margins, and because I think it's a little bit of, they have a couple of really good years and then they don't rip their backlog. Their backlog doesn't keep up with their growth, and then they have a couple bad years and the stocks really sell off. You rarely see this type of appreciation in this industry. So those are my comments there, and I appreciate you being a member and asking, and I'll take any questions you have, and you can email me if you have other questions. Let me know. Sergio, good to see you. Box for Fun, thanks for sponsoring the video. And then looks like we have a user. Excuse me, we have an attendee. I just wanted to say hello. Thank you for joining. So Box for Fun. So you want to look at Box for Fun. You want to look at Serve. So I'm going to keep this one in case there's a question. So let's go to Serve. So Serve Robotics. Wow, up 222%, but down 35% for the 5-year. All right. I love volatility, but boy, this one might be a little too much. Let's take a look. So Serve Robotics designs, develops, operates low-emission robots that serve people in public spaces for food delivery activity in the United States. It builds self-driving delivery robots. Cool. Okay. And just a personal, I think they were using these. So my older son graduated from a university in West Los Angeles, and the university bought these for the students to order from the restaurants on campus, and then the little robots would come over to their dorm, and voila, the food was waiting for them. So it's a neat little idea, especially in very densely populated areas. You have, this makes a lot of sense. Now, you could easily, if you're densely populated, right, you can walk to the restaurant and pick up your burrito versus having this little robot get it to you. But maybe these are going to be the next thing in hospitals, right? Like, I was in the hospital visiting a relative that was hospitalized, and of course, you have the cafeteria delivering food to the rooms and so forth. Well, maybe these little robots are going to start taking over that. We'll see. So I could see a lot of use cases for them. So it's neat. Now let's see. That's the business. It's very futuristic. It's kind of a use case that will continue to mature. Like this isn't mainstream, right? It's not like when you order food on DoorDash, a human being shows up to your door and hands you your food, or Uber Eats. We're not to this point just yet. At least I live in Southern California, south of Los Angeles, and where I live, it's not quite mainstream. It's I don't know where it is mainstream. So this is a tiny cap company, and I think that's what's causing some of these humongous returns. So we're going to look. So we looked at the website, and we're going to look at their investor page too. So, excuse me for a sec. Okay, so Serve Robotics, 554 million in market cap. Their revenue 1.3 million. Whew, that's tiny. So you're paying 500 times revenue for the company. 500 times. Okay. Nvidia, you're paying 10, 15 times revenue. And that's proven. Okay. So this is like, whoa. Okay. We're in the deep, deep end of the pool. You don't have any ratios here because they don't make any money just yet. But analysts are bullish. They're like, strong buy, discounted. Okay. Let's take a look. So it is a small revenue company. And this revenue, like I mentioned, the university that my son went to, they had these little robots. But I think it was a neat kind of thing that the university wanted to do, which is great. Probably the engineering department was like cheering them on, like, wow, that's really cool. But it's not huge revenue. It's like they were 1.8 million in revenue. And I mean, that's not a lot of revenue. And then the revenue has dipped. You know, if you look at the trailing 12 months versus last year. So the revenue is just tiny. But look at their expenses. They're putting 24 million into R&D. Their operating expenses, which is paying accountants and HR department, office managers, you know, the systems to run the company, like accounting systems, operational systems, inventory systems. It's pretty expensive operation. We're going to look at their balance sheet to see how many years of cash they have before they're going to run out of cash. So they're losing a lot of money. Okay. This is a startup business. They are looking at, hey, someday these little robots are going to be everywhere. And then we're going to have a head start on the rest of the industry. We're going to be ahead of the pack. Now they're burning cash. They're burning about $40 million of cash each year. And that's just consuming that cash. So what's important is we need to look at the balance sheet and see how much cash they have. So they have $197 million of cash with very little debt. Good job, guys. Now, they probably got the cash when they IPO'd, and there was an IPO, and maybe, and I'm going to look at the balance sheet closer, when the stock price really goes up, these small businesses are smart to sell some shares because a corporation, when they IPO, they, in the accounting behind it is they say, okay, we're going to have a billion shares available as ownership in this company, but we're only going to sell like a third or a half or maybe 3/4 of those shares in the market. And then we're always going to have these shares that we could sell in the future. And they may sell some of those shares when the stock price really goes up. If you look at like GameStop, remember that short squeeze? That's what they did. And they built up their cash. And that's a good idea because businesses that are struggling, if they see their stock price flourish, it's a very quick way of generating cash so they can have that cash and then rebuild and repair their business. So we'll look at how many shares are outstanding. So these guys have roughly, call it 5 years of cash. So they have time to figure it out, figure out how they can start producing revenue because they need to. But we're going to look at a closer look at that balance sheet. You see that they have that cash. They do have a little bit more cash, which leads me to believe they issued out shares. And where's that share count? And here's the share count. And here it is. So they went from 24, and these numbers in thousands, probably million, but they doubled their share count from 23 to 24. And when we look at the stock, from 23, so they IPO'd. No, this is where they IPO'd. Okay, so it was the IPO when they issued out all those shares. So it wasn't that they were diluting the company, I don't think. So that is fine. That's normal. They just IPO'd. So that looks okay. So this one here, you know, this one, the way that I would make a decision on Serve Robotics is, what's the addressable market they're going to go after? Is it humongous, or is it small? Is it a kind of a niche kind of market? And I don't know. I think it could definitely be a market, but I'm kind of thinking through, let's think about New York City together, right? Now, New York City is densely populated, and you have a lot of delivery on e-bikes. I noticed that. I was in New York maybe a month, 2 months ago. I've been to New York probably 6 times in the last 2 years. And you have a lot of delivery on e-bikes, human being. But the thing about that is, the e-bike delivery guy gets to a building and he parks his e-bike, locks it, secures it some way, runs into the building, goes into the lobby, and or there's probably a table where you put a delivery. And then on the app, you tell the customer, hey, your food's in the lobby. And the customer comes down to the lobby, gets their food, they're good to go. So the human being got it to the front door and walked in. Now, I didn't see any of these little robots in New York City. I wasn't looking for them, but I didn't notice them. But I noticed a lot of e-bikes. They were everywhere. The reason I noticed them is I like to walk in New York City and take the subways, and you got to be careful because you don't want to be hit by one of these e-bikes when you're walking across the street. So, but I could totally see that there is a use case for these little robots. But I wouldn't say that it's inside my sphere of competence, of knowledge. It's actually outside that sphere. And you look at universities, could these be helpful, like in university campuses? Well, it was installed in one of my son's universities, but it wasn't wildly, used. It wasn't like, oh man, that little device is getting used quite a bit. It was more of kind of an interesting thing the university did, and it did catch a lot of attention. It was written up in the paper and stuff. And believe it or well, when I say the paper, it means that the website that the university has. We don't really use newspapers anymore. So that's where I'm at with the stock. It's totally outside. You can't use fundamental analysis. You can't do valuations on this company. It's a little bit of looking at the future. Now, I have swung and missed on businesses like this. I'm going to go back to it was 99 or 2000. I invested in a company by the name of Webvan. They do grocery delivery. They did grocery delivery. They're bankrupt now. Totally made sense to me. Totally made sense. I just had the timing wrong, because now we have food delivery, we have grocery delivery, we got everything delivered, right? I just didn't have the timing right. And I would say that I paid a big price for a lesson on that occasion, that if there's no fundamentals to support the business, if they don't show evidence that, hey, people really want this particular technology or this particular service, maybe I got to rethink my investing idea. And this one here, I'm not seeing the revenue growth. I would not invest in this company. It's like too risky, way too risky. And it's I mean, it's enjoying a good year. If you bought here, I mean, you're doing terrific. But just imagine if you're the investor that bought at $22 a share, you're feeling miserable because you've lost more than half your investment. They just don't have the revenue. If they had gone from like 1 million to, and it's early days, right? It's really small company. They did go from $110,000 of revenue in 22. They doubled, and then they went up to 1,800,000. These are tiny numbers. I mean, these are like, it doesn't even register. They got to start showing like 50 million, 100 million. Then we're talking about a business that might make it. So this one's a very interesting one. Glad you brought it up. I'm probably going to notice these little robots a little more often. But we'll see. And I think this is going to be like on the factory floor. It does have a good use case, but these guys got to start getting installed. If they could start showing that, hey, we're getting installed in factories, we're getting installed here or there. All right, then we got something. But right now, I'm not seeing enough execution to make me a believer. I'm a non-believer right now in this business. Thanks for asking about it. And I can't do any fundamental analysis because there's no fundamentals to analyze. But thanks again for being a supporter, a member. And again, please get me your email address so I can get you all set up with the perks. Thanks, Box for Fun. David Jackson. Hello, sir. Hopefully you're doing well today. And thanks for your support. Appreciate it. Do Me Trash. Sebastian. Okay. And you're welcome, Box for Fun. I'm glad to do it. And, I'm 56 years old. I like investing in companies that make me money. I love stocks like, Robinhood. We're talking about a super futuristic company here. I like stocks that perform well. I'm going to show you A-Lab to show you some of the investments that I really like that are big bets. Kind of like these are not like, oh, I invested in a boring company that's been around for 100 years. This is a semiconductor company, A-Lab. The reason that I really like the company is data centers need to communicate with one another, where you pass data from one big workload to another big workload. And those data centers, in order to communicate, they need the best technology. And these guys are right there. They produce a really good technology. The reason I believe that is they're growing at 242% last full year. That's incredible growth. And we're not talking little numbers. They're up to 400 million in revenue, and they continue to grow at high rates. So this stock has had volatility up, down. So it created a great opportunity. And I started buying into A-Lab. So I am a risk taker, but it has to have elements of realistic elements. Okay, I understand this space. It's in my sphere of competence. I understand data centers well. It's part of my professional job. And these guys are a semiconductor right in the right place at the right time. And they're growing super fast. Okay, you can't find businesses that are growing 200% that are legit. And they're making money. Look at these gross margins, 75%. NVIDIA-like, right? NVIDIA-like. And free cash flow. It's like, geez, this is what I want. These guys are proving to be hyper growth, making money, generating cash. The big story makes sense to me. It's all green flags. So I'm an A-Lab investor. So I'll leave that with you because it's great that you're thinking. I mean, the two stocks we've looked at are big picture stocks. Robotics. Yeah, got it. I think robotics is cool. And it's going to be a big space. But is this the right company? And then the data center, right? Quanta Services. Data centers need power. They're going to need this construction company to wire, more power to data centers and infrastructure. So both of those companies are part of this big picture. Yeah, I get it. I just would encourage you, try to find the companies that are going to resemble, back to my analogy, like Astera could be the next starting quarterback of the Philadelphia Eagles. These guys could be, they're going to go from 14 billion, I don't know, to 50 billion. They could be acquired because they're in the right place, right time, with a very special technology that enables data centers to communicate faster. And this one could be a rocket ship ride with real fundamentals behind it. The art of investing is being able to take qualitative data, which is big picture analysis. Hey, the big picture says that robotics and power is going to have to be delivered to data centers. Data centers are going to be huge. That's qualitative. Okay, that's one piece to it, but you got to marry it with quantitative. Let's look at the revenue, profit, cash flow. Is this business worth having? Am I buying an equipment manager or a quarterback stock? If I'm buying an equipment manager stock, I have to be realistic. That stock's just never going to go up super high because it just doesn't make the margins. It doesn't make the cash flow. So I'll leave you with that example. All right. So Doomy Trash, good to see you. All right. So looks like we have 25 people on the stream. Thanks so much for spending a part of your Wednesday morning with me. Let's take a look at the stock market. We've gotten deep into two stocks that members have requested, appreciate it. And the market is in the green. We got the NASDAQ in the green, up 0.26%. S&P's up slightly, just barely there, and then Dow's up there. But the S&P is in the green for the year. Man, I will drink to that, even though it's just water. And the year we've had, right? We've had a pretty good correction, 18.9% on the S&P, but it's battled back. And part of it is that we had tariffs, now we don't have tariffs, and that looks really good. So we've battled back from, a bear market, and I don't know that we're out of the bear market. For all we know, a month from now, we're down another 10%. That's the stock market. But for now, let's just enjoy this upward ride. One of the lessons that, I take away from looking at a market like this is I got to stay invested. Now, it doesn't mean that 100% of my capital is always in stocks. Part of my capital is in bonds. Part of it is in interest generating money market accounts. But a majority of my capital is working. It's working in stocks because it's really hard to time the market. Hey, do I get out here? Do I get out here? Maybe you got out here and then the market takes off on you and you're like, oh no, I have to get back in up here. Well, you just lost money. You just lost the, 3-4% on your portfolio. On $1 million, that's $30,000-$40,000. If you keep doing that, it adds up. Maybe you're losing $100,000, $150,000, $200,000 a year. So timing the market is extremely difficult. Nobody's been proven to be able to do it. But what is wise is constantly look at your portfolio and try to manage it to what you're looking for out of your portfolio. Are you looking to retire? Are you a young person, 35? You just want to maximize the return, and you want that portfolio to keep getting bigger, more valuable, because we all know, money, capital, it provides freedom. If you don't want to work and you have a lot of money, you don't have to work. If you want to take a vacation and take 2 months off, money will get you there. So being invested at all times is pretty much a constant. That's an expectation. Carrying some cash in money market accounts, not a bad idea. It's risky if you go, oh, I'm going to go 80% cash. Whoa, okay. That's going to be risky because if the market does this to you, you missed out on 18% of gains. That's could be a pretty big penalty. All right, so market is flat. We'll call it flat. Hopefully it doesn't turn into the red, although it wouldn't be a big giant surprise because we've had such a good week. I mean, we really went up on Monday from Friday to Tuesday, up 5.7 on the NASDAQ. I mean, that's a big jump. So if the market kind of sold off a little bit with people taking profits, wouldn't be out of the question, right? Okay, so that's going on. All right, so Anthony, what's been your best gainer over the last year? Robinhood. So Robinhood's up 247%. And I liked Robinhood's story, even though I'm not a Robinhood user. And here's why and I just did a video on Robinhood. I released it yesterday afternoon, but I'll kind of repeat kind of like some of the reasons why. When I started investing in Robinhood a year and a half ago, 2 years ago, I believe that Robinhood is serving a market that didn't exist 20 years ago. Robinhood's going after the younger investor. They're not going after me, 56 years old, or a 65-year-old, or a 75-year-old. I think my generation and the older generations, we were put together and we were raised with literally paper statements coming to our homes. And we would review our statements and, oh man, I did well or I did bad. And that's just not the world we live in today. I'm showing you multiple browser pages, and I have access to information 24/7. Now back to the clientele of Robinhood is they're marketing to the 20 to 35-year-old, and they're dominating that part of the market. That investor is more risk on, which it should be. Younger investors should take higher risk, try to find, great hyper growth stocks that just do great returns for that investor. There will be some stocks that investor will buy that are just complete dogs. That's part of the process. If you nailed every single stock you picked, you'll be a billionaire. And maybe there's a couple of people like that on this stream. But for good investors that go pick high growth stocks that are young, Robinhood is a really good platform, and they really focus on that investor. They did zero cost trades. They did all those things. So I really thought their vision made a lot of sense. The addressable market was there. I thought that they were doing the right thing because the old school Charles Schwab's and, those types of, the JP Morgan clientele, it's been a lethargic, old school network kind of industry that is ripe for disruption, and Robinhood is just destroying them. They just come about it with a different way. They're into crypto. They're doing all the right things. I married that with fundamental analysis, and I just thought these guys are going to crush their market cap. They're just going to do great, because when we look at Robinhood, not only do I believe in the big qualitative story of Robinhood, like, okay, it's going to be big. Not only are they going to be big, they generate cash already. They're a free cash flow generating company. Their margins are stupendous because they don't have to produce a product. Like the construction company we looked at, they have to put people in the field, run power lines, and it's dangerous and so forth. Robinhood is like, we have this platform. If we have 1 million customers, it costs about the same whether we have 100 million customers. But when we go from 1 million customers to 100 million customers, we get far more profitable and we generate a lot of cash. So the cash generation is stupendous. They make money already, even though they're a young business. And the future is really bright for them. I think they're going to have a huge addressable market. And all those things have kind of fallen into place. And this has been my number one percentage gainer. It beat out everybody. And that's the answer to your question. And how could I find the next Robinhood? Maybe it'll be A-Lab. Maybe it'll be a couple of others. I think pharma provides really good opportunities out there. You know, I put out a top 5 stocks to members. So if you're a member, you can see that video. I produced it yesterday. And those, I put out 5 stocks that I think each have a good story. And there's a couple in there that are hyper growth. And there are a couple in there that are kind of like a little old school, but are just super discounted. So hopefully that serves everybody. The next Robinhood is out there. There's probably 10 next Robinhoods. There's probably 10 next Palantirs. There's probably 10 next NVIDIAs. We just got to keep looking for them and find the right characteristics married with the right quantitative numbers. Because once you have a company that has a great story and they have great numbers, boom, that's NVIDIA. NVIDIA had the right story at the right time with the right numbers, and man, that stock's just flourished. So that's the answer to your question. Donko Penco, thanks for joining. I appreciate it. All right, cool. So thanks everybody for joining. Let's get to some earnings here. So today is the 14th. We have Sony announced before the market opened. We'll take a peek at that, see what they're doing. And this company here, Make My Trip, I have no idea what these guys do, but I wanted to take a look at what they announced. Then you have Dynatrace, which I don't know what they do. So we'll take a look. So Tony, I've been watching a lot of investor relations meetings with RXRX. All right. So before we jump into the earnings announcements, let's take a look at RXRX. So Recursion Pharmaceuticals. So 1 year down 52.75. So this is a $1.8 billion market cap company. Recursion Pharmaceuticals operates as a clinical stage biotech company, engages in the decoding biology and chemistry by integrating technological innovations across biology, chemistry, automation, data science, and engineering to industrialize drug discovery in the United States. Okay. So they have like a drug discovery platform. And they're not the only ones that are trying this. I know that ABCL, they became prominent because they did help, and they helped one of the companies that came out with a vaccine for COVID. That's an example of somebody who hit pay dirt with their platform. So here's their platform. Okay. And okay. This has a future. It's just really hard to nail which company is going to win, which company's going to just continue to be in an exploration kind of journey with never really hitting commercial success. And it's not like, so within pharma, my level of competence, I understand pharma enough to know when I'm looking at a quality, profitable pharma company or life sciences company, but I don't know the science itself. Like if you asked me, explain the biology here, explain the chemistry that's going on here, I'd be like, I can't do that part. So let's take a look at the fundamentals, which I can do. So they're not profitable yet. Okay. Their revenue is 60 million and they're 1.8 billion. So you are paying, what is that? Is that 30 or 300? So that's 30 times revenue. So it's a little expensive, but let's take a look at their growth. So they are growing nicely. Now they're selling to, their customer is a pharmaceutical company. Their customer is Pfizer. It's Novo Nordisk. It's another pharmaceutical company that's like, hey, we're trying to do drug discovery for this illness, or we're trying to find a better cure for a certain illness or condition. So these guys are selling to that type of customer, and the revenue is good, 29%. Okay, cost of revenue is really high. So their revenue is 60 million and their cost of revenue is 432 million. So they're losing, just to do the programs they're being sold, they're losing 372 million. Those are big losses. Okay. So they don't generate cash. They're burning a lot of cash. They're burning $398 million of cash in the trailing 12 months. Okay. So how long have these guys been around? So they've been around for a while. So it looks like they probably IPO'd in 2021 and the stock's really sold off. So, all right. So looking at their balance sheet, so they have 400 million of cash right now. They're burning about 400 million in cash. So they have to see what needs to happen is their revenue needs to go up and their costs need to come down, because you can't keep burning that kind of cash and survive. They have about 1.5 years of cash. If nothing changes, then things are going to get tight. So this is high risk. They haven't like when we look at A-Lab or Robinhood or some of these stocks that are working, they show early in their life as a company, early on, they show positive cash, and cash might come before profit. And this company is not showing that. Okay. That's one thing that I'm concerned about with this company is as they get a little bit bigger, they're burning a lot more cash. It's like, whoa, wait a second. I get that some businesses are interested in having you do your thing using your platform, but the growth isn't incredible, like 200%, like A-Lab, or 100 and some odd percent like NVIDIA. Yet you're burning a lot of resources just to deliver that amount of revenue. So this company here is looking far too risky. The risk reward isn't there for me. The risk is they're going to go bankrupt. They're going to run out of cash. They're going to be sold for assets. And then instead of it being a $4.46 stock, it's going to sell for 10 cents, 25 cents. And that would be a huge loss. The reward is, no, this thing does, do well. Well, I'm not quite sure I like the business inherently. I like to call out an obvious, success is like I think Palantir is priced too expensive, but let me show you what Palantir has to offer. When you look at the Palantir business, this is a young business, right? They haven't been around forever. They've been around since 2021. And when you look at their growth, good growth, margins, 80% margins, cash flow, it's there. I still think they're too expensive, but you see that in Palantir has real evidence that, hey, this business could be really valuable someday. It's not a promise. It's like, hey, we have evidence here. I'm delivering evidence that we have a valuable business that is growing well. Okay. Now, this is a stock that's done really, really well, right? That the valuation is incredible. You're paying 100 times revenue. PE is 566. Oh, man. So, yeah, this is proven to be a very viable business. It's just priced really expensively. But what I wanted to show as an example is these guys are not showing any evidence of it being a viable business yet. So take a look at ABCL, right? So ABCL became really popular because they helped, and they IPO'd right around the time when COVID was happening, and they helped Moderna. I think it was Moderna that was one of the first companies that came out with a vaccine. Well, they used AbCellera, and AbCellera was able to license, or they got a royalty out of that deal. So they immediately said, "Hey, look at us! We're making all this money." So they had kind of a period of time when they were really exciting, but since then, I mean, it's not pretty. And this is a company that they hit pay dirt, but then they weren't able to repeat it because after the COVID vaccine, it's like, okay, there's nothing left. That's it. And they are mainly operating on grants. Like a university says, hey, we'd like to study this particular life science, and they go to AbCellera, and then they provide some revenue to them. But this has just been a really, really tough situation for investors. I'm afraid that, and AbCellera, I would say, is, probably looks better than this stock. Let's look at ABCL. If you look at their revenue, you see this is where they helped with COVID, and their revenue went up almost 2,000%. And then COVID went away, and now they're down to 23 million. So this is not, I'm sure, what you would like to sign up for, right? Hey, I want to lose 90% of my money. Nope. So just the risk reward is not there for me on this one. It's way too risky. So thanks for asking. So they have like 10 drugs out for approval. So that's where you have an advantage. Okay. If you're doing that kind of homework and you're seeing that they really are being successful in getting drugs approved by the FDA and getting to the commercial stage, then stick to this stock, because you could have an advantage. Just be realistic, right? Be honest with yourself and make sure that you're seeing the fundamentals that are going to deliver, that are going to make you a big return. Stay on it. I think if you're doing that kind of homework and you do see that 10 drugs are out there for approval and they're getting approved and you're seeing the success in the pipeline, then keep bringing up the stock, right? Keep bringing it up on member calls. We'll keep looking at it, but we'll be honest about, they got to start showing evidence of their true value. If they can show evidence that, hey, we're beginning to increase our revenues because we helped this big pharma company accelerate the drug discovery process, and now every drug company wants to do business with us, and we're charging more money and we're making more money. Okay, perfect. Now we got something, but we have to see the evidence. Good one. Thanks, Anthony, for bringing that up. All right, so let's take a peek at some of these earnings. We got Sony, and these guys are up a little bit. This is, of course, Sony, that sells so many different products. Just a great Japanese company. What's their $154 billion market cap? It's not a bad return. And look at this volatility, man. In 2022 was their low point. So these guys are doing well. Go Sony. How did I not find Sony before this moment? I like Sony. Now the stock's really up. So interesting. Let's take a look at their growth. Growth looks good. These numbers are in the Japanese yen. So we'll just look at growth rates, and then we'll look at a different stock analysis does a nice job in statistics to convert foreign currencies to US dollars. So their growth is really good. 10% growth looks really good. And so their revenue US dollars wise is 87 billion. Gross profit, not a lot of gross profit, because they are competing in kind of old categories of consumer electronics and a variety of things. So they have 9 billion of cash, 27.8 billion of debt. So they have some net debt there. And free cash flow wise, they do 9 billion in free cash. This is a good stock. It's a good value stock because, well, yeah, it's a good stock. It's probably discounted by 20, 30%. No, I take that back. They're priced too high. For some reason, I remembered this number 87. Yeah, these guys are worth probably about 110 billion, just high level, and they're priced too high. I'm sure if I would have seen them back here, they would have had a different valuation, but rear view mirror investing, right? It's easy to see. Hindsight's 2020. So that is Sony. They're having a good day. Looks like their earnings were good. Dynatrace provides security platform for multi-cloud environments in North America. Okay, you got my attention. They IPO'd in 2019. So this is cybersecurity. They're growing well, but it isn't like incredible numbers, right? Like CrowdStrike's growing faster. There's cybersecurity companies are growing faster. Now, these guys are a $16 billion market cap company. These guys have consistently grown. Looks good. Good margins. Free cash flow looks good. And look at this cash flow growth. That's very good linear growth, right? You see that upward slope. 2020 doesn't count because it's a COVID year. You have a pandemic. All kinds of businesses suffer. But everything else is nice and linear, up. Okay, very good. And then we've got profit margin is good. Gross margin is stupendous at 82%. So these guys, interesting. These guys look pretty good. So they're based on their growth. I mean, you could pay 10 to 12 billion dollars for this business. And they have $1 billion of cash. So maybe you pay 13 billion. And they're at 16 billion. So the stock's done well, I imagine. No, not that great. So these guys are a decent cybersecurity company. Cybersecurity is a crowded space, right? These guys are priced at a premium, and their growth isn't overly exciting. They're small compared to some of their competitors like Palo Alto, CrowdStrike, and others. And the growth rate is good, but if you're small, you have to grow much faster because, Arista Networks is growing faster than you. Palo Alto, CrowdStrike. So this one here is decent, but it doesn't make it across the goal line for me. I have other cybersecurity stocks that I'd rather buy. Make My Trip, online travel. Okay, so they're a travel site. 40%. Holy smokes. Man, looks good. And I think these guys do international stuff. It's not like for the American market. I think that's, yeah, there it is. It's in India. So when folks in India want to travel, they use this website. I'd never heard of them because I'm using Airbnb and I go straight to the airlines but actually I use Google to search the best flights, and that's how I get to my ticket purchases for airline tickets. But these guys are in India. Interesting. Looks like they've been doing well. And they announced today they're down a little bit. Their numbers, let's look at the quarterly. Their numbers look good. Good revenue growth. Very good. I was expecting a little bit of a negative quarter with everything that's going on in the world. All right. So we covered those bases. We covered the earnings. Not a lot of big ones. Tomorrow, I think we have I think Walmart coming out and Cisco today after the market closes. So that one will be interesting. All right. So just take a peek at the markets before I close the shop here. NASDAQ's up a little bit. Let's look at the heat map. Who's doing? Oh, Google. Very good to see that Google is doing well today. NVIDIA keeps its march going. Salesforce. Good to see Salesforce is up. United Healthcare recovering some of its losses. Walmart's doing well. Netflix is doing well. Tesla's doing well. Palantir, Microsoft. So there's some green out there, but there is some red as well. Looks like utilities are selling off quite a bit. Materials selling off. Real estate, as interest rates have crept up, real estate's kind of taking it. Casualty insurance is taking a hit today. Uber's down. I'll probably buy some Uber today. Pfizer's down. All right, so that's what's going on. We're 42 minutes into the open, so things are beginning to settle in. Looks like it's going to be a mixed day. Some companies are going to do well. Some of the big caps are going to do well. These big caps have kind of been really rolling right now. They've been going up. So all right, so that's what's going on there. I think that's good. Okay. All right, so I am going to close up today, and thanks for joining me on this live stream. I really appreciate. I've had a couple of new members to the channel. It's easy to get signed up. You hit join, and you can get into whichever membership would be ideal for you, and you get really good perks. You can attend member calls. You get access to the tools you saw me use today. And I'm producing a lot more content for members, members only, and I'm going to keep doing so. I've got a video outlined for today, and I share my buys and sells with the members twice a week, midweek today, Wednesday, and then on the weekends. So share, what I'm planning to do, and I also share other content that's just for members only. I had an article produced yesterday as an example. So consider it. It'd be great to have you. I know I've seen some of the names that attended for a long time on streams. Would love to talk to you on the member calls and see how we can collaborate and do better with the stocks. So take a look at it. I really appreciate it. So everybody have a good day. Good luck with your investments. Hopefully it keeps going deeper into the green today, and we have a third consecutive day of up stocks. So thanks for tuning in. Really appreciate everybody's attendance. Take care.